All right. Hello, everyone. Welcome. Just gonna give about 30 seconds to a minute here. Let everyone get in, get settled here. But thanks for joining.
Thanks for hosting.
Of course, for you, anything.
I
So,
don't get to hear that much in my life.
what I'm here for. So, I see some people coming in here. Give it a few more seconds. All right. All right. Well, I think let's start. We'll get started here. I see some people still filing in, but Um, thank you everyone for joining today. I just wanted to tackle a couple things before we hand it off to Mike here. But first off, this webinar will be recorded and sent via email after the fact. So if you miss anything, you will get a copy being sent out. Additionally, tomorrow, Mike's investment newsletter, I believe tomorrow morning, that will be going out via email as well. So you can expect that newsletter out tomorrow. And then last thing I did want to touch on for today. At the end, we will have a Q&A on Zoom here. There is a Q&A feature. So during the webinar here, if you do have any questions, feel free, throw them there. We'll get to go through a few questions at the end here. Again, if there's anything specific to you and your situation, obviously we'll relay to your advisor and make sure you can get that answered as well. So um, thanks again for joining, everyone. Really appreciate it. My name's Tom Irvin. I'm a senior wealth advisor here. I've actually started at Diversified actually as an intern back in 2011, came on full time in 2013, and have been here ever since. Been in various roles and currently in an advisory role here. So um, also wanted to introduce you to Mike Horwath. He's Chief Investment Officer here at Diversified. If you have not met him or seen one of his webinars yet, he joined here in 2016, and since then he's led the investment committee, proving to be a key role in really shaping the firm's investment strategy. He works very closely with the financial planners here to help ensure that each client's investment approach supports their long-term financial goals. Mike is a CFA charter holder, and he holds a degree in finance and economics from the University of Pittsburgh. So welcome, Mike.
Hail the pit, Tom. Uh,
All right.
Thank you. And Tom is one of the few people who precedes me at Diversified, and he has been integral in our growth and just uh, working with his clients and the clientele there. So one, thank you for hosting. Um,
Thank you.
Happy New Year, everybody. Thanks for joining us. This is our normal quarterly webinar. So the idea is to every 3 months we get together on a more formal basis and really go through what's going on in markets, the economy, what's working, what's not, what are the main themes, how are we thinking about really the economic and market backdrop, but then how are we kind of talking about that in the context of positioning portfolios? Because at the end of the day, that's probably the most important thing as to how we, translate one into the other. As Tom said, the newsletter is going to be coming out here tomorrow morning. The newsletter is really a similar content to what we're going to go through today, just written form, more graphics, more more content. So if you really want to dig into it even further, you'll see that tomorrow morning. So feel free to jump in. But we're wrapping up 2025. When we look back at 2025, in general, I think across the board, right, uh, risk assets, more conservative assets, right? Whether you're talking about equities, fixed income, across the board, right? Financial assets all kind of performed really well. So if you look at returns by asset class, what you'll see is a whole lot of positive. There was, nothing really negative. Equities clearly drove returns for portfolios. That's been a common theme going back to really 2023. So this is now 3 straight calendar years of really, really strong returns. One of the unique things about 2025 was in the US, a little bit more of a concentrated part of how the market worked. We'll kind of touch on that. But then really when you look globally, international took the lead, and that's something we haven't seen for quite some time. But you see really within both developed and emerging markets, international stocks outperformed US stocks, right? Something that I think a lot of diversified investors, right, who would globally diversify their portfolio, they've kind of sat there and said, well, why don't we just keep leaning heavier and heavier into US large cap? And even though US large cap, the S&P 500 performed really well, we saw international not only add value to portfolios, but really be a big driver of outperformance uh, within an equity portfolio. So you saw international, both developed and emerging, over 30%. Here in the US, you saw really the mid to high teens right on the S&P 500, but small cap lagged a little bit. We'll talk a little bit about that there, but still double digits around 12, 13%. Fixed income, coming out of 2022, clearly fixed income had a really rough year, down 13%, worst calendar year. And now we've had three straight calendar years really of just kind of evolving into a core staple to the portfolio. So naturally, you look at fixed income to diversify your equity risk to provide more stable returns. And you saw here in 2025, looking last year, over 7% returns in taxable fixed income. And then in municipal bonds, which is more tax-free or tax-exempt fixed income, up over 4%. So across the board, financial assets really perform well in 2025. And at the surface, you look at that and you say, well, it was a really strong, consistent year across the board. Well, I think if you rewind, it was certainly a tale of two. I don't want to say halves because halves wasn't quite exactly the case. But if you really take the first, call it quarter to one third of the year, and the second, call it three quarters to two thirds of the year, those are the key differences, right? So the first quarter was all about tariffs, right? It was all about this concern around deglobalization, implementing tariffs. You saw markets pull back from February like 19th to April 8th very, very quickly. All of a sudden, you fast forward to the end of the year, that got erased. It almost had this 2020 feel to it with COVID, where February 19th, the same start date to what was March 20th at the time, or 23rd at the time, where markets pull back really quickly, and then all of a sudden, things rebounded very, very quickly. But the first really quarter to a third of the year was defined by this whole change in tariff policy, concerns around what tariffs could do to inflation, to earnings, to the consumer. All of a sudden, the second half of the year, the second, call it three quarters of the year, all of a sudden was all about the fundamentals. Right? What do we mean by fundamentals? Really comes down to earnings, margin, growth. And at the end of the day, right, you saw those components, right? The fundamentals outweighed what we would call kind of this wall of worry, right? This worry around what policies could potentially do, right? Because it's all potentially could do, but we didn't see it in corporate fundamentals, at least for the second three quarters to two thirds of the year. We'll touch on earnings later, but at the end of the day, right, earnings were a huge part of it. Profit margins remain really strong. Earnings were phenomenal for the really calendar year 2025 and are projected to continue to be that way into 2026. Things aren't cheap within equity markets, but you have this backdrop of corporate earnings really not only strong, they are continuing to grow. And we know over the long period of time that stock returns, right, or stock prices will follow earnings. So if earnings are going up and to the right, you would expect stocks to go up and to the right over the course of time. Now, there are other factors for sure, but that is something that underpins this entire market. And part of the conversation around this AI bubble, or our markets poised to fall. And we'll touch on that throughout this conversation. But the good part is corporate fundamentals on the back half of last year won, right? And markets should be driven on fundamentals, but it wasn't a smooth year. Interestingly enough, too, we just touched on it. You saw European equities and really even just global non-US equities perform really well. After years of underperforming US equities, you saw European equities, mostly driven on defense, a little bit of financials, really have a strong calendar year in 2025. What I would caution people is, while we believe in diversification, we will continue to use international equities to diversify our portfolios, both developed and emerging. We don't believe that US outperformance, or what some people call exceptionalism in terms of equities, we're not shying away from the US. And we'll touch on that as to why, but some of the kind of the key factors is the earning conversation. Stock prices will follow earnings over the long term. The challenge we have with some of the international performance in 2025 is if you decompose what drove the return was driven on multiple expansion, which just really means that European and really non-US stocks were really cheap, and then they got a little bit more expensive. Earnings didn't necessarily have to change. They just got more expensive. People were willing to pay more for them for the same earnings level. That's what we call multiple expansion. The second was you get this combination of the US dollar depreciating, and you get that tailwind for owning international stocks. That currency conversion was a tailwind for international equities. So when you think about the three main components of the return, it's earnings, multiple expansion or contraction, and that last piece of currency. Well, the two that drove returns were probably the two that we think are the least sustainable when compared to earnings, right? Earnings power. And then lastly, if we think about 2025, bonds were meaningfully positive. They were a contributor to returns, right? Up over 7% in taxable fixed income. When we think about historically what's happened within fixed income, we know that historically they carry less risk than equities. They are a diversifier for equities from stocks. But it's nice to get that diversified positive return from a part of the portfolio that's really the more stable part of things. So in general, I think you saw a lot of bears, right, talking about all the concerns, right? There's always concerns, right? Inflation, you have deglobalization, you have changing tariff policies. There's plenty of things, right? AI, capital spend, which we'll talk about in a second, asset prices. There's always things to be slightly concerned about, and that will toggle up and down. But those who were bullish and who stuck to owning equities, who stuck diversified, did really, really well in the context of absolute returns within their portfolio. Within equities, it was vast majority all driven off of AI. And when we look at 2025, earnings did grow meaningfully, right? Double-digit percentage earnings growth across the S&P 500 as an example. But if you looked at what performed well in 2025, most of it was driven off of either the top names in the market, right? The top 7 to 10 names, most big tech, mostly AI centered or AI tangential. And then others were companies that were pretty much tied directly to the AI theme. So the AI theme was in full front and center for 2025. So what I caution people is to not look at 2025 where a rising tide lifts all boats. That was not the case. The number of stocks that outperformed in the index, right? The number of stocks that drove returns within the index was very narrow. That's an environment, one, that it tells us, one, we're not in a bubble because not everything is just going up. Two, it is healthy, right? Because you want to see that dispersion. You want to see stocks doing well that deserve to do well, stocks not doing well that don't deserve well. But I also would say that it gives me optimism going into 2026 that there are a lot of businesses that are trading at good valuations that are also seeing earnings growth, other asset classes outside of even just US large cap, talk about US small cap, or the S&P other 493 names, right? So not the top seven, the other 493. You're starting to see the earnings growth flip from the top seven names driving growth to the other 493, to small cap driving earnings growth, which has not been the case. That trend has really been delayed, and we thought it was going to happen in 25. It's been pushed to 2026, but I think broadening out is good for equities. But this conversation of AI, what we saw in 25, you're going to hear all about capital expenditures, which just means how much money these companies are reinvesting into this AI build out. So you think about companies like Meta and Google, who their ad revenue, they have so much free cash flow. They are just reinvesting it out. You're seeing companies like Oracle, really leading the charge on data center build out. There's good and bad here. Good that it helps drive growth. It also sets a foundation for hopefully future earnings growth. The concern is when you start seeing companies start to really build up, and you can see it on the graphic how 2026 capital expenditures have really grown for what we would call AI hyperscalers. You're talking about the top names in the market. You're thinking the Googles, the Metas, the Oracles, the Nvidias. They're really, really climbing at a really incredible pace. The concern naturally becomes is you need to start to see the benefit of that capital expenditure, not just spending money. So this is something we're focused on. But if you think about what happened in 2025, this was a huge part of it and a big part of the conversation. On to fixed income, when we think about it, I remember going back to 2023 and the conversation we got, and candidly, we still get it. We got it in 24, 25, and we're still getting it today was, well, why wouldn't I just continue to own a high yield money market? Mike, I was getting 4.5, 4.75, maybe 5% at this peak on high yield money market. Why would I go and extend into bonds, right? Investment grade bonds and extend what we would call duration, right? Just get off of very short term, extend historically, and our comment was always the same. Historically, when rates peaked, bonds typically outperformed those short-term money markets and CDs on a forward-looking basis because guess what? When your rates peak and they start coming down, you have to reinvest or your money market. Guess what? The day that the Fed cuts its rates, you are probably going to see the yield on your money market drop the next day. And that may be an exaggeration in some instances, but it's not that far off. Whereas if you can lock in rates for longer and extending when rates peak, this is why we've really kind of pushed and said, hey, it's okay to get off the sideline. I know it's hard to look at 2022 and say, bonds fell 13%, but that's a scenario where looking forward, it was, in our opinion, the correct move for at least a portion of the portfolio or for individuals who are sitting on a lot of cash. And now you're starting to see those benefits here in 2025. And we think it'll continue. But after it peaked, the Fed funds rate has now been coming down, right? The Fed had cut 3 times in 2025. You're likely to see a new Fed governor here in 2026. You're likely to see that governor, right, or the Fed chair be more accommodative to trying to push down interest rates because that clearly is a key component of this administration. So to me, was one big thing. Remember that debate about should we be in cash or should we be in traditional fixed income? And for 2025, you saw, traditional fixed income up about 7 to 7.5%, while cash returns were closer to 4%. And if you look at 2026, you're probably looking in mid threes on cash. It's assuming the Fed does not cut rates more aggressively, which, we don't think so, but that's also making an assumption. So you're seeing on the right-hand graphic where, those treasury, there was 1 year, the 1 month treasury yields, right? The short-term cash, the orange graphic or orange bar, that's really come down from its peak. So to us, you remember this conversation. We've had it so many times. This is something I think investors should always consider. It's hard when markets are zigging. Bonds took a hit, but it made the sense to get off the sideline into non-cash assets. And I think, you saw it in 25. The other interesting part was this rise of gold. We got a lot of questions about gold in 2025. And I think you look at the return of it, becomes pretty clear. It was, remember, gold is driven off of not earnings. It's a supply demand conversation. But there's some structural things that have changed, right? A weaker dollar, interest rates dropping. Whenever you see global trade and uncertainty, geopolitical conflicts, gold typically does well. And you saw this massive quick rise as a diversifier in 2025. So we look at gold as one of those things where I think the expectation has to be the right one when owning it. It should be something as like a purchasing power part of the portfolio where you're trying to, if there's a debasement of your currency, it's a diversifier, a little bit uncorrelated to equity and fixed income, right? And look, long term, like the returns can be probably a similar profile to inflation long term, right? But conceptually, the idea being it's a purchasing power protector. So to us, we don't use it as a huge part of any portfolios, but our conversation is always if it's kept in the right context and you're trying to accomplish, purchasing power, maintaining it, one, equities do a really good job of that. But two, look, if you're looking for another diversifier, something along this precious metals route could be an option within a portfolio. So one of the things I always like to do January is to revisit our 2025 predictions and make some 2026 predictions. And this can go incredibly well or incredibly bad, depending on how far you want to stick your neck out and uh, what ultimately ends up happening. But I think it's a good exercise. And then what we ultimately look to do is talk about our predictions in the context of how we're positioning portfolios. Because making predictions and doing nothing with them to us doesn't make a whole lot of sense. So one, let's start with the bad, right? Let's start with one of the predictions that didn't work in 2025 was our belief that the equal weight S&P will outperform the cap weighted, meaning the other 493 would help to drive portfolio returns above the top 7 to 10 names in the market, which had been really a theme for some time. That still hasn't happened, right? The equal weight underperformed the cap weighted by a few percentage points. So once again, I mean, it's a kind of a binary decision, either did or didn't. It hasn't. We thought that this trade would start to work and this theme would start to work in 25. It looks like more likely in 26. And it's less about fading or running away from the top 7 names, just acknowledging that there's a lot of stocks that have been kind of left out of this conversation, mostly because the top 7 names are the strongest earners in the market. But that didn't work in 2025. 2026, we do think there's going to be some semblance of this coming to fruition, but until we start to see that earnings start to flip, where the earnings growth is driven off the other 493, it's going to be hard to see this come to life. I think one of the things we were really strong on is, well, while we are not running away from Chinese equities, they're not a huge part of our core portfolios. We own some emerging markets. But we just see, I think, the structural challenges of China as a headwind for what they're going to do. So, I mean, in short, we really thought that their fiscal stimulus, which was a talk in 2024 going into 2025, would come up short of really driving incredible growth, which it did. It just hasn't been able to outrun consumer concerns around, especially the debt levels and real estate market within China. So, while there's been plenty of performers within China that have done okay, interesting companies, it's still an area that we aren't leaning heavily into. One, we just think structurally it does have some demographic challenges, debt challenges, just a consumer spending challenge right now. I'll skip the next one. I'll touch on that in a second. But then, one of the things we thought was, the Fed would cut rates 3 times, and they cut rates 3 times. And interestingly enough, I should say probably, I would not have predicted that the path of cuts would have been in the last 3 in a row. I would have thought it would be more spread out, a little bit more methodical. But what we saw for most of the year was the Fed hold tight, and then they started to see some unemployment breaking towards later part of the year a little bit, and they became more comfortable with the ease. And you saw 3 straight rate cuts, which is kind of where we thought it would land. I think going into the year, you probably could have made an argument for 2 or 3. We erred on the side of believing it was going to be more rate cuts, and that's the way it worked out. Thinking about GDP and inflation, I think coming into the year, our expectation was probably more of what we would call that soft landing, or soft or no landing, meaning that we weren't going to go into a recession. GDP would remain positive. It did. We still want to see that perform better. We still think the GDP levels are a little bit concentrated, especially with business spending. We want to see the consumer drive more of it, but far from a massive scare right now. We also thought inflation is going to be hard to get down to 2% or sub 2% to where we were several years ago. And that's what worked out. You see it on the graphic today. CPI really pretty much landed the year somewhere around the mid to high 2s, depending on which measure you're looking at. And this is another theme for 2026. I think inflation is going to continue to be pretty sticky in this level, right? Which isn't scary, if you're the Fed, but it's also not sub 2%. It's not off the radar. It's still there, right? 2.5 to 3% is still a little bit elevated above where I think the Fed would like to be, especially if it's leaning closer to a 3 over 2.5. So inflation, GDP, both looked pretty good within 2025. Inflation came down, which is the positive, stayed above. It's still a little sticky. We think the risk is to the upside, which we'll talk about here in 1 second. But What are our predictions for 26? I think one, right, is let's start at the top right. I think the S&P has a 10% correction, but it actually finishes higher. And this isn't as crazy as it sounds, right? I mean, corrections happen all the time. We would expect, markets to be a little volatile given all the uncertainty, right? There's geopolitical tensions. There are still things to be figured out on the tariff side. I think AI has had a great run. There's still a lot of questions to be answered with AI, and we'll see where market sentiment goes. Here's what I come back to though. We are still optimistic on equity markets because of that fundamental backdrop of earnings. If earnings come in where they are projected to come in, which is another, call it close to 10% growth above where they were in 25, it is hard to see markets really falling all that meaningfully, at least here domestically, because that earnings backdrop with profit margins, you may see sentiment fall and investors kind of sell off, and maybe what we would call valuations kind of get contracted. Maybe people are willing to spend less or less optimistic, but we are still optimistic for 2026. We do think it's going to be choppy. We'll go out and say there's going to be a 10% correction. And when that happens, and if and when it happens, I think it is probably more of a buying opportunity than it is to certainly run from markets. Just mentioned, I still think inflation finishes above 2%. I have a hard time seeing inflation finish below 2% unless something drastic happens, and you'll see how we reflect that in our portfolios. But to me, the risk to inflation is to the upside, meaning unexpectedly high rather than all of a sudden coming in way lower than we expect, finishing, or coming in under 2%. So we still believe inflation comes in above 2% for calendar year 2026. We aren't going to go out on a limb and pick a lot of individual stock returns, but I always think it's fun, especially with how the Magnificent Seven stocks, right? These big tech stocks, um, how dominant they are of everyday life and markets for sure. I thought I'd make a prediction here in terms of the top names in the markets. Look, we're going long on Amazon, and we are thinking that Tesla is the worst performer. On the Amazon side, I think the answer is kind of simple. It's similar to Google, right? If you looked at Google going into 2025, everybody, and even the first part of 2025, all the conversation was around antitrust. Google traded cheaper than the S&P, even though it was growing way faster than the S&P 500 in aggregate. Everybody told you that OpenAI and ChatGPT was going to replace search engines. And all of a sudden in 2025, Google was up over 60%. That narrative changed so quickly. Amazon's going through the same thing where so much of the focus is AWS, right? Amazon Web Services, which is, one of their big drivers of growth and margins. Is it falling behind? And they've been kind of beaten up. We think Amazon has proven enough that they're going to correct what that looks like on the AWS side. Obviously, the retail side is still really strong. I think Amazon is a good starting place. And I just think Tesla has so much built into, from a valuation perspective, like it's not a car company. And if it is a car company, it is incredibly overvalued. It needs to develop the robotics and the technology, and you need to see progress. You need to see the numbers start to come to fruition. I just think what's baked into the stock price is way too much risk to the downside. So look, if we're going to make a prediction here, up on Amazon, down on Tesla, just personal opinion. Last one. I think the Fed continues to cut, but the 10-year Treasury stays above 4%. Why is that important? So I think people think of interest rates across the board that when the Fed cuts, everything goes down. I think it's important to understand that, and you've seen it recently, and I'll try to point it out here, that while the orange line, which is short-term rates, have come down, the 10-year hasn't moved much. And that's because the 10-year is much more driven on inflation, growth, fiscal conditions here in the US, whereas short-term rates are much more driven on where does the Fed place short-term interest rates. I think running consistent fiscal deficits and the current inflation backdrop, which isn't bad, and we still have some GDP growth, that's reasonable here in the US, just have a hard time seeing the 10-year getting pushed down too much. And I think the question is, what does that mean? I think it means that, investors who are diversified in core bonds will still see yields that are pretty good, right? And this is why moving off the ultra short term and just extending a little bit, we think has some value. Two, I think, mortgage rates are not based on what the Fed does. Mortgage rates are much more based on what the 10-year looks like. So I think everybody who's hoping for this lifeline of mortgage rates just plummeting as the Fed cuts, you're going to be disappointed in that while you may get some drop, you're not going to get a commensurate drop what you see on the Fed side. So I think that something has ramifications for the real estate market. But I think, when you look at the yield curve right here, this top line, the red line is, what looked like at the end of 24. And then you see the other two, which are the later part of 2025. And you see while the short end pushed down, and even the intermediate, the 10-year did push down, not nearly to the same degree. And you see as you go out to the 20 and 30-year part of the curve, kind of barely moved. We would expect more of that. You're going to likely keep seeing this yield curve, what they call steepen. And I think this is part of the portfolio construction conversation, and it has economic impacts naturally as well. I think to wrap it all up, the important part is you hear where things stand, what we think is going to happen or what has happened. How are we thinking about portfolio positioning? One, I think we are still very constructive on equity markets. You have to acknowledge, like, look, the starting place is expensive. I think some things have been pushed hard, right? The AI conversation's been pushed hard, and there are some companies that are going to fail. We are still optimistic because of the graph on the right. You see earnings here in the US continue to push really, really high. And the important part is the shaded area is the earnings per share, and the line, the darker line, is the S&P. You see they follow very much in tandem. Earnings on these individual stocks are going to drive the stock price, which is the way it should be, right? That is ultimately what matters as the owner of a business, the underlying earnings in terms of the asset price. So we are still constructive. I think a lot of people have asked us, price targets on the S&P. Look, I think you can make an argument up. And to what extent is going to depend on a couple different things. I do think, look, there's some things to always be concerned about, but the underlying sentiment should be fundamentals and profit margins are really strong. That's a good starting place. You're also going to get monetary policy help. You're going to get fiscal policy help. That should be helpful. We are still overweight the US over international, where you're going to continue to be. It doesn't mean that we're not going to maybe look to increase international here and there, something we're always considering, we're actively considering right now. But we just prefer to be a little overweight US, especially given this earnings backdrop relative to the international space. International may be cheaper. You may get the dollar weakening benefit, which is good in the sense of you own those assets, they perform well. But in terms of international consistently outperforming the US, you need to see earnings follow along. Because we do see some of these, especially the top of the market, we see some unprofitable businesses, doing well in the AI space that, we're just not sure, until you start to see the benefits of all the AI investment. We're leaning more into dividend-focused equities, dividend-growing equities, just in terms of high quality, high free cash flow. We just prefer to live there rather than being in this high risk, lower quality type world where, we just expect more volatility there. And then look, the semiconductor industry, if we're talking about technology, is still a space we really like. It has gotten a little frothy, in the sense of, Broadcoms, the AMDs, the Taiwan Semiconductor. A lot of these businesses have done really well. We are getting a little concerned on how expensive it's gotten. But it's an industry, you've heard us say this for years, and it's really paid off. But that is something that we continue to lean into. On the fixed income side, we still prefer being in core investment grade fixed income over high yield. Why is that? High yield's lower credit quality. You get higher interest on it. But right now, we just don't feel like you're being compensated to take on a little bit extra risk in core bonds. We'd rather just stick in investment grade. And, a lot of our leaning is towards corporate fixed income. Why? Because look, treasuries, while they are protected by the US government, we expect a little bit of volatility with the yields in the sense of, whenever the government's running these fiscal deficits, naturally the credit quality and worthiness of the US starts to come into question. And as crazy it is to say that, like that happens, and you've seen it. Corporate fixed income, the corporations are very healthy. You're seeing free cash flow, margins, EBITDA, all these numbers, they look really healthy. Owning corporate fixed income is kind of where we like to live right now. But going back to the inflation conversation, we are hedging some of our fixed income with tips. So tips are something that they're treasury bonds. So when we own treasury bonds, we kind of prefer right now to own tips in the sense of if inflation does get unexpectedly higher, we now have the ability to benefit rather than what likely would happen is that your bond portfolio would get hurt, similar to 2022. This just will help buoy that in the event that inflation is a little bit sticky or comes in unexpectedly high based on what's priced in the markets today. Okay, I've said a lot, Tom. I'll take a step back. Are there any questions or anything that I can expand on?
Thanks, Mike. Really appreciate it. Very, very informative and like the outlook looking forward with your projections. Got a couple questions here. First is to you and kind of ties to one of your projections even with a potential correction, right? How and I field some of these calls too, but how, in your words, how should long-term investors respond to types of short-term volatility if we do see a pullback like that, similar to how we saw even earlier in 2025?
Yeah, it's a good question. So I think first and foremost, you have to be prepared, right? You have to just know what your exposure is. Hey, if markets pull back, what could my expectation be? I think for those who are comfortable, who either have a little bit of excess cash or a willingness to maybe adjust asset allocation, to me, if I saw a 10% correction, I'd be a buyer, right? So if I'm a long-term investor, look, you can't time it perfectly, but I think the backdrop um, is supportive of equities. I think, equities over the long period of time have clearly proven short periods of time, we know that they can be volatile. To me, if I'm a short-term investor or a long-term investor right now, staying diversified. This is why we're up in quality when I say dividend focused equities. But if I saw kind of a broader market pullback and the opportunity arose, I would be comfortable leaning back into equities and either increasing or using it as a rebalancing point. That's something we like to proactively do. Is you saw in 2025, we did it twice. We did it once early in the year where we after markets fell in the first part of the year, we used it as an opportunity to rebalance so we could buy equities after they had fallen and increase that. And we did the same thing at the end of really July into August. We used it as an opportunity to just take some of that equity growth we saw and just kind of right size our portfolio because otherwise it can get a little bit out of whack in terms of either more risk or less risk than we really want.
That's great. No, thank you. Thank you for that. I did get another one come in while you were talking there. I think projection wise, again here, looking forward through 2026. I need to touch on small cap. Question is, how do we see small cap versus mid cap throughout 2026?
Yeah, I see them a little bit similar. To me, what you saw in 2025 was this lower quality small cap start to do well. You still haven't seen like the upper echelon of small cap and mid cap really kind of take off the way you would like to see it. I do think that there will be a turning point. And look, our preference is to be higher quality in small cap and in mid cap. Same conversation where we prefer to own something like the S&P 600 over the Russell 2000, right? Because we can just own more profitable names in small cap rather than the 40% of small caps that are unprofitable. I think those companies that are profitable, that are higher quality, just haven't been really rewarded in markets. It hasn't really been their time to shine. That's where I would live. I would live at the upper echelon of small cap or mid cap rather than the lower, junkier part of small cap, which relies on high levels of risk taking in markets. You also would need to see um, you're going to see the Fed cutting rate. That would be the other part of it. And you really need to see GDP growth taking off, which is not what we would expect. So I think higher quality, the upper echelon of small or mid, that's where we would want to live, going into 2026.
Thank you. Thank you. Looks like may have one or two more here. I think that this one ties to look, we've had a good run up in the markets, right? And what about, someone who is potentially a little nervous to put money in, given that, hey, there might be another pullback, or we're at the top of the markets here. What would you say to that person?
Yeah. I would say yes, markets are expensive. Two, that you're never going to time it perfectly. So how do you mentally work through that? I think you can do a couple different things. One, you can take the guessing out of it and dollar cost average. So a lot of times what we'll do with clients who have a large chunk of cash that they need to deploy, but they're not comfortable doing it all at once. We'll do what we would call a dollar cost average, which is a common thing. Every month systematically you're inputting, so you're taking the guessing out of it. And then what we would do, and then we've helped our clients do this, is um, we would opportunistically, if markets fell, so let's give the scenario of a 10% pullback. We think, look, you can do chunk in month, dollar cost average in, but if markets fall 10%, accelerate that, right? Use it as an opportunity to accelerate. I think that's one of the things that we would look to do. I think, one of the challenges is always that second guessing of timing it perfectly. Look, this is always the case, but every single price target I've seen for 2026 on the S&P is higher than where it's at today to varying extents. It doesn't mean it's going to be perfect. It doesn't mean it's going to actually happen. But what I would say is in 10, 20, 30 years, do you expect that to be higher than where we're at today? And that, should help drive that answer, being a long-term focus. But I think, dollar cost averaging or creating a plan to take some of the emotion out of it while being flexible with if markets fall, you don't have to just stick to it. You can accelerate it. Uh,
Right.
I think that's usually a strategy that's worked for us historically.
Yeah, that's been a great strategy we've implemented with some clients. So that's a great answer there. So it looks like we may have time for one more. I did see a flurry of them came in, so we'll get to we'll email the rest out to you personally. But one last one here. It's hot on the spot today. What's tipping the major indices into negative territory today?
Well, it's one of those things where it's, you know, especially between earnings season. Now, we're going to start entering earnings season, so a lot of the market's going to be driven off of that. But what we've seen recently is, you still have a lot of questions in the air, right? You have the Fed DOJ probe. So here's what you'll see. Anytime you see volatility at members of the Fed. You see the bond market, which will drive equity markets as well. They get spooked. A lot of bond investors, especially, don't like monetary policy disruption. So I think that continues to be, especially, and today, it can be, I'm talking more like the last even couple weeks, right? Some of the main headlines, the Fed being one, two. I think, the potential for a cap on interest as an example for credit cards. You've seen companies like JP Morgan, Capital One, Amex, MasterCard, get hit because of this expectation. I think there's still just uncertainty around policy from that perspective. So to me, in between earnings reports, we're about to enter one, but like in between, especially any of these conversations with changes in policy, you're going to see move markets at any given time. But those are two things that we've been talking a lot about recently with just what happens at the Fed, and then two, just this credit card interest and what the likelihood or possibility is of that.
Great. All right. Thanks, Mike. No, we're kind of close here on time, so appreciate you running through everything here today. And as a reminder, this is recorded and will be emailed out. Mike's newsletter will be going out tomorrow morning as well via email, so keep an eye out for that. And um, thanks again, Mike. Really appreciate it.
Thanks for hosting, Tom. Thanks for everybody joining.
All right. Thank you.
Take
Bye.
care.